Hey traders, welcome back to Park Avenue Trading. Your chief dealer, Tom, keeping you sane in insane markets. And today we're going to be diving into an important concept in trading, volatility. If you ever wondered why prices shoot up one day, collapse the next, this one's for you. Let's break it all down. What is volatility? Market dynamics explained for you. The first thing that we have to say about volatility is that without it, we can't make money. When a market is not volatile and it's consolidating, it's very tight price compression, it's really difficult to make any type of money. So volatility, is a short-term trader's friend. Okay, and that's also a long-term trader's friend. It's really, really important to get volatility in so that we can make some money as we trade. So really, volatility is the heartbeat of the market. It's what makes prices move up, down, and when there's no volatility, it's sideways. Okay, but technically, it's the measure of how much the price deviates from its average expectation. So why does it matter? Because volatility reflects change. And where there's change, there's opportunity. Volatile markets can lead to large profits, especially if you're trading with leverage. But remember, that same leverage can work against you just as quickly. That's the risk-reward trade-off that volatility introduces. So next time you see a spike, a spike on the chart or a crash, understand this. You're not just looking at chaos, you're looking at volatility in action. So how do we exactly measure volatility? How do we use it to our example? Well, in my chart down here, I have an RVI index. And of course, the movements happen after you could see the spike in volatility, but you could also see that it's slightly a little bit lagging. So really you need to introduce, average true range with this. But the first step of analyzing this is like anything. It's really understanding the market dynamics themselves. And what I'm talking about is market structure. Now, I've been hitting market structure for a lot of videos, but it's very, very important. Market structure is very important. So if we were looking at sterling yen, which is quite volatile, I mean, thank goodness for that, because there's a lot of opportunity to make some money. All right. So if we're looking back at market structure, this is a 12-hour chart. We could see that the market made a low. It came back up and made a high. But the most important thing to look at is this high right here. It hasn't been surpassed. So the market right now is saying that they're in this area right now, okay, if I get a geometric shape here, up in this area, there are sellers, okay? So right in this area, let me move this out of the way and let me try to expand this. We got a double top that we're looking at right here, okay? So that was actually showing that there was some sellers here. Now, I want you to notice that as the marketplace is coming up here, if you look at the volatility of the market, there's not really a punch up. There's not a punch up. Volatility will increase on breakouts. It will kind of stay stagnant when a marketplace is really trading like within the range. Okay, so at this point, this chart came up to the upper levels of this range. Now, it's a 12-hour chart. So really, as a short-term trader, you'd be looking to sell this with a stop above here. You'd also be looking at volatility to see if there's an increase in volatility. Now, you notice, look, this last punch, okay, right here, we came down. Volatility was kind of, still at the median point, all right, of this RVI index. However, there was a spike in volatility right here. This was probably short-term traders looking to think that a breakout was going to occur, because if we look at market structure, what we got really short-term is we got a low, we got a high, we got what would be considered a higher low at that point. So really there was some buying interest several hours back in this area right here. So let's just highlight that so we could show it. All right. So we can learn from this stuff, right? So there was some buyers that were interested in taking the marketplace up higher. Now, two things could have occurred at this point in the chart. There could have been the sellers that got short up here that's saying, look, I want to escape right here. That also fueled a little bit of a rise in the market. But now look at this. We got another lower high. Now, when this marketplace breaks this low, it comes and it trades very close down to this area right here. So again, you have short-term traders that are actually looking to buy the marketplace here. Either they went short or they're just actually saying, hey, we're coming down near this low. I'd like to get involved. I think that the marketplace could rise. Market does. It's a nice movement. I mean, from 189 to 194, that's not a bad movement for a short-term trader. However, the structure has still, if we look at the volatility or the RVI right here, all right, it's up at the upper limits. It's the same as this. So this is actually signaling that there's potential movement, back down, okay, or the volatility will increase. Volatility, like I said earlier, volatility increases on breakouts. So if we were going to take a trend line analysis, let's say we take from the top of this and we come down and we have a trend line breakout up here. The market can't even really get to it. However, when we come down in here, look at the RVI, okay? The RVI right now is also showing that, well, there's not many more sellers here. I mean, it kind of came down very, very close to the lower range of the RVI, but now it again, the market bounced up, all right? Again, right to that trend line that we put off of these 2 points. Now, if I wanted to, I could adjust another trend line, and I could come and say something like this, like we got a double trend line there, right there, coming off of this. Or actually, I could even bring this down lower off of that peak. We get like a vector in there. But the market at that point, the RVI was showing that it was topping out, like over here again. Market came down again. Market tried to rebound again. Couldn't take this top out. So you say, all right, this is all well and good. It's all history. But where would I expect that the breakout should occur? Well, if I'm looking at the 12-hour chart, I'm looking at really right here at this low point right here. I have some mixed signals with, the RVI index. It's consolidating a little bit. But we had a low, we had a high, we had a higher low, we had a lower high, we had a deeper low. That is the point. That is the point, that if the market actually does this, comes up, and then turns down, you would see volatility or the RVI actually start to really spike, start to get really, really strong. So market came up, came down. Now look at where the RVI is, okay? It's kind of like it's not really doing much. It's actually signaling now. Now it would, if this marketplace came down beyond this low, you would see a spike in this. If that would mean that like more people are getting involved, more people are actually selling the marketplace, all right? So that is a decent way of looking at this. Let me get over here. I'm trying to give you some good pointers on this, but you really need to understand what the market structure is. And that is the most important thing. Like, what is the market telling you? So really where the breakout occurs, and it still hasn't happened, is above this 198. There's still a lot of sellers up there. So if we go forward with this chart, we could see, let's see what happens when this was the low that we were looking at. Let's look at the RVI right here. It spiked. It came down. The selling pressure was pretty strong on this, and it bottomed out again right here. So now we got in the market right now dynamics. We got the low. We got a high. We got a higher low. We got a higher high. we have a deeper low. Market dynamics would say that really this marketplace has to hold this level, and it does. It comes up, comes down, makes a higher low, makes a lower high. Like according to this high, it's still a lower high, but this is a resistance point. I mean, it's a resistance point. It hasn't changed, and we come down, we make another, higher low. We come up to the top. We can't break through. So if this marketplace would have been able to break up through there, you would see that the index itself would be pushing as well, because there'll be a lot of people getting involved, fueling the fire. So, you could use this. You can the RVI. You could use ATR, which is really what I like to use, the average true range, to gauge daily price ranges. That's a little bit more easier to understand than this indicator itself, because it is, slightly lagging indicator. Okay, it needs actually to follow price, but an ATR is not. An ATR is basically, the average true range of what a marketplace has done over the X amount of time that you choose. So when you could see that you're at the higher levels of ATR, and that it's been in a consolidation, or it's been rejected at highs before, you'd be able to enter a short with a little bit more confidence, and it helps to make money. Or you can enter a long with more confidence if you know that you're down really by the low of the ATR. Basically is showing you that the average true range is on a 6-hour chart, or 8-hour chart, or 12-hour chart. Like, actually, let me pull one of those up. Hang on one second. All right, so now I pulled up an average true range, and you could see that at this point the high is 1.976 big figures. Okay, now the average true range kind of goes down to one big figure, so you can get an idea that if you're up 196 points, 184. Let's see, 184 even 1.96, and anything above like 185.96 is actually showing you that the marketplace is kind of reaching a peak point. Now, you wouldn't just go sell 185.96s. No, you'd wait for the marketplace to try to give you a turn point. And of course, like we said up here, this was actually a good turn point. So at this point, you would realize, like, hey, I'm way above the average true range, so a market should snap back to the middle. And actually, it did snap back down, but we're still right here in the marketplace as it stands right now. So you got to look at the charts themselves. You got to see how violent the swings are. A lot of times, when news comes out, there's violent swings up or down, but those are sometimes really great opportunities to actually scoop at a lower price, because the market structure is actually saying that it's down by a low that should hold. Or if it spikes up, market structure says that we're at a really, a high point that, says that it should turn down from there. Of course, it's never, it's never guaranteed, right? The trading is never guaranteed. That's why it's that risk reward situation when it comes to volatility in action. All right. So that's a really important point. So I hope that this has been able to help you out. So you just got to understand that volatility is more than just noise. It's your true trading environment. And the key is learning to measure it, manage it, and use it to your advantage. So I hope that helps you out. I mean, I was thinking about doing this video for a little while. It is June 7th, 2025. And I'll see you tomorrow for the weekly updates for the currencies. Have a great day. Cheers.